a little less in growth mode and more in profit maximization mode. I think you're going to see more platforms be added to the S&P 500 over the next handful of years. That kind of dovetails almost very perfectly with them saying, okay, let's make a lot of money. So PLAT, we've got 70 public platform companies in the PLAT ETF. We had done some analysis on, I think maybe like Q2 of 2019 and what portion of the platform stocks are in the S&P 500 and how much do those platform stocks contribute to the S&P 500 earnings. And so we decided to extend that research and look at this for an entire year. So from Q3 of 2019, going back 4 quarters, what does that look like? And basically what we saw, let me zoom on in here. You've got 21 companies out of the 70 companies in PLAT. You've got 21 that are in the S&P 500, and 15%, little over 15% of the annual earnings of the aggregate S&P 500 companies, which there are 500 companies, which means you have 21 of the 500
little under 5%, basically.
Little under 5%, which is contributing over 15% of the S&P 500 earnings. Now, here's what's really interesting, because some of the platform companies in the S&P 500 are kind of older, right? Like a MasterCard, a Visa, NASDAQ,
CME Group,
CME, CBOE, Amex, and ICE, the Intercontinental Exchange. So they, typically when you have the older, more mature platforms that have dominated space, they're able to. They might be a little less in growth mode and more in profit maximization mode. When you see the younger platforms that are still up and coming and they're really more of a growth play, certainly all the large cap tech stocks are pretty much always evaluated on their growth aspirations as opposed to their earnings. But you still see an outsized portion of the earnings coming from a Microsoft, a Facebook, an Apple, a Google, little bit of an Amazon here. But I think what's also interesting is when you look at a market access, which I don't think many people know about, which is the dominant. I think they have 85% of the volume in bond trading.
Secondary bond trades, right. And they're a newer company, so that they really scaled, and we've talked about them a few times about their history on this show, but they really scaled after the financial crisis in 2008, when basically a lot of the stuff moved away from banks. And there was a need for an intermediary to come in and basically build a platform. And that's exactly what they did. Mm-hmm. And they're doing quite well, still growing, but also making pretty good money.
Mm-hmm. Making very good money, but they just kind of like Amazon in its earlier years, they would just reinvest all those earnings back into the business because they say there's so much growth here. Oh, and I'm only going to now continue to consolidate, put up more barriers, and really put as much of a stranglehold as I can on the 85% of market share that I already have, because now there's more competition coming into the space. And so they're only going to double down on that. And as we've seen, the platform model basically is inherently a winner take all model. That's the name of our show. And they're very smart and well ahead of all the other competition, and very small actual penetration compared to the overall amount of loans that are still being traded on the secondary market. They have 85% of that kind of digital space, but the amount of offline trading that's still happening still vastly outweighs that of the digital trading. So I think that's interesting to look at. The other thing to take into account is, so the median year founded of all of the 70 companies in PLAT is the year 2000. Median year of their IPO is 2011. And so basically what you're seeing is, to be in the S&P 500, there's rules. And so basically I think you're going to see more platforms be added to the S&P 500 over the next handful of years.
Right. I mean, you've had at least a dozen big platform companies go public in the last 12 months.
Yep.
And then probably a few more to come. I know Airbnb is coming out next year, from what they've said. So
you need to be profitable. I think you need a couple years of earnings. There's a few rules to be inducted into it. But I think as you start to see just more platforms go public, and I think you're seeing platforms also go public at a later stage and all these things, but you're seeing more platforms go public. They have more of a track record as a public entity. Then they can be inducted into the S&P 500. That kind of dovetails almost very perfectly with them saying, okay, let's make a lot of money. And let's really turn on the profit engine side of the business.
You also have, in some cases, companies like Expedia, which originally was more of a linear kind of reseller, shifting toward the platform model, which is why they're in Plat. And that's been a story for them over a number of years that's been in transition. So interesting to see you also have companies there that are shifting from linear to platform. I expect we're going to see a lot more of that in the S&P 500 in the next 5 years.
Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.